Escape from the central bank trap. And of course, this is about what's on the balance sheets here. But instead of dwelling on that, can I ask you, what do you think has changed as far as the way we should view the Fed now in the wake of that inflation data on Friday and the weak retail sales number?
I think that we can expect the Fed to be a lot more cautious. I think that inflation expectations at the end of last year were a little bit too aggressive. The idea that oil prices and food prices were going to feed into core CPI, that the unemployment would start to see wages growing more than expected, it was a little bit too optimistic. So I think that the Fed will take a little bit of a more calmed approach to rate hikes. I think that the market is already reflecting in its expectations that the Fed will take a little bit of a slower pace in those rate hikes, and while continuing with its idea of normalization of policy, taking a closer look at core CPI in particular, which is surprisingly less positive than expected with the level of unemployment in the US.
How should investors think about this? Because bad economic news or less good economic news should give pause for thought here, but as we know, people have traded bad news as a reason to believe easy money continues.
Exactly.
But how do you think investors should think about it this time round, given that we are so long in this cycle?
I think that the way in which investors should not look at it is to buy the dip on bad news to get into more cyclical stocks. I think that what you need to do is to be very, very aware of that slowdown in consumption, slowdown in investment as well, because there was a tremendous expectation of capex going up. So I think that what you need to be is less exuberant with cyclical stocks. You need to be paying more attention to earnings growth. Going back to the old formula of looking at stocks in which you have good buybacks and good dividends, and being cautious, because you cannot expect that monetary policy is going to go back to QE. It's still a normalization pace. Therefore, taking a little bit of money out of cyclicals that have worked quite well is a good idea.
Let's talk about the Goldilocks rate of interest, because that was really what came up last week, where neutral is, and after Yellen says, well, we're approaching that level, I think the market sort of have really pulled that neutral rate or Goldilocks rate lower from above 4%, where it used to be, to about 3%. Is it even lower than the assumptions of 3%? And is that why we're now hearing comments from the chair of the Fed that we could be seeing Goldilocks within sight?
I think it's going to be lower than 3%. And I think that in any case, it is very, very difficult right now for the Fed to take a stronger action on interest rates when the level of debt continues to be so high, when margin debt is so high. But also, you have to think, if the economy is not growing as expected, if capex is not growing as expected, and if retail sales are not going as expected, and wage growth is not improving, therefore, you have to be at least a little bit concerned about the ability to repay as maturities come closer. Between 2018 and 2020, the U.S. has some, I think it's 5 or 6 trillion of maturities. So therefore, you have to be very, very careful.
So put on the record, the market's sitting around 43.1% chance of a rate hike now in December. What do you think?
I agree with that. I would agree with that. I think that one rate hike is possible. While all this data might be a little bit softer, it is still an expansion. And we need to be aware as well that the Fed continues to be between 250 basis points behind the curve. Therefore, they need to take some action, but at the same time pay attention to the slowdown and to the softening of data. Therefore, that's why I think that you should be very careful about taking an aggressive stance on cyclical stocks, because it's still a normalization pace. It's still an economy that is in expansion, but not as some expected, probably too aggressively after the elections.